Hey everyone, welcome to episode 2 of the show. Another week gone by, and this is week ending October 7th, 2022, and lots has happened. We're going to catch up with Jason Meyers, the founder and lead architect at Auditchain, and see what he thinks about some of the things that have happened over the course of the week, starting with the rumors around Credit Suisse and the notion that they might be having problems with credit default swaps and them and another number of banks. Any thoughts?
Well, nice to see you again, Yoli.
Welcome.
Welcome everybody else to episode 2. As far as the rumors go, so in my observable history, these things rarely, if ever, play out in the manner that everyone thinks they will play out. And they always play out at a time that no one else expects, right? So over the last weekend, there were a ton of, failure,
Right.
right? And Deutsche Bank and Credit Suisse were the subject of those failures. But that's Twitter noise.
Right.
It's Twitter noise, right? Show me the work that you've done. Nobody's shown us any work, real work, right? And that's real heavy analysis. It involves financial data that's stale, and it involves external resources like current pricing for all of the components in each of their inventory, right? So when you look at these types of situations, one, you look at, in the case of Credit Suisse, how much debt is outstanding? How much money did they borrow to operate the bank, right?
Right.
And then what is the market pricing that debt at versus the credit default swaps, right? The insurance on default.
Right.
So for those who are watching, a credit default swap is like an insurance policy, and they trade amongst banks. And it's a one-time premium that you pay for default insurance, right? There are variations of them now, but these are the types of things that you have to analyze. Then you want to know what they have on their balance sheet in their inventory, meaning their trading desks purchased other bonds, fixed income products, credit default swaps, possibly, right? And you want to see what kind of leverage they use to purchase that inventory, because the purpose of a bank is to make markets and fixed income securities, one of the purposes, and to facilitate orders by their customers, which means they're going to have to sell things they don't want to sell or buy things they don't want to buy at a specific time in order to keep their customers happy. That's what market making is all about, right? So in the recent run-up in rates, which means the prices of bonds come down, right? You have the eruption of these rumors, right?
Right.
So I will pose a question to the audience and to you, where the background is these banks are governed by the Basel III framework, which is a battery of tests under economic stress to determine their ability to withstand that stress, right?
Right.
So I would pose the question that if you look at Aave and specifically Compound, which has a really good governance system, and you compare it with the ability to determine or avoid failure or stress by traditional banks, right? Then you have to make an assumption for a moment based upon the fact that the downturn in crypto had no systemic or structural effect on Aave or Compound itself. They're fine. They did really, really well. Banks not so much, right?
So,
And you won't know whether or not a bank is actually in a state of failure
until it's too late.
until
Yeah.
it's too late, and until they report it, right? By the time they reported it, the board of directors gets together and makes a determination based upon their capital position that we're not, this is it, right?
Right.
Now,
And
assuming
so,
they don't have any risk management, I mean, they all have risk management systems, but those risk management systems are compared to a blockchain governance and risk management system, right? A collateralization threshold that literally stops and expels excess risk. You don't necessarily have that type of rigidity inside of a bank.
so for those who are new to the blockchain space, maybe just simplifying, like what is inherent in the model with blockchain that would prevent banks from getting to this stage? Like, is it about the transparency? Is it about the real time, able to see data in real time? Like, what is it about the blockchain that would change?
Well, it's all of that stuff. But for instance, during times of high stress, the community of governance token holders, for instance, on Compound, will get together and they will raise the collateralization ratio of a pair, right? So the community actually determines the risk models through that governance rather than a board of directors or a risk committee at a bank,
Right.
right? But
Right.
the risk committee at a bank may not have as much insight as to what's going on at other banks, which is a critical element in managing risk. Whereas the community that gets together on all these DeFi protocols are
Connected.
They're connected and interwoven.
Yeah.
So you have the ability to discover systemic and structural risk,
Right.
So, and that is a lot more transparent and it is safer than a Basel. Basel is something that you read on a website or in a book.
Right.
Prescription, right? And then it's got to be incorporated into banking systems, which means mechanized.
Yeah.
But systems don't necessarily talk to each other, and each of the banks are not as interwoven from a risk management perspective as a lot of these protocols are.
And you're also reliant on, business executives sort of making the right decision and not being, not freaking out or biased. And the other thing is, there's a domino effect. I think that's why these rumors became such a bit of a spike. Was there's a domino effect. If one of these banks has challenges, we don't know who else is impacted, right?
Well, here's the way it works, or the way it worked in traditional banking. And I'll never forget this. It was 2008, I believe. And it was about a week before Bear Stearns really took a turn for the worst. What happened was, and I wasn't actually in the room when this happened, but I know people that were on the receiving end, either directly or indirectly, of a memo from Goldman Sachs instructing traders not to trade any instrument where Bear Stearns was the immediate or one step removed counterparty to the trade.
For shares of Bear Stearns, as the firm has been buffeted by constant rumors of a looming liquidity problem. Bear maintains that its balance sheet, capital positions, all strong. The stock, which rallied yesterday, still down 17% over the last 5 trading sessions. Joining me now first on CNBC is Alan Schwartz. He is Bear Stearns president and CEO. Mr. Schwartz, thanks so much for being here this morning. Good morning, David. Good morning. Let me start off with this broad idea that's been in the market now for a few days and pressuring your stock, namely that counterparty risk is something, new counterparty risk is something that a number of firms on Wall Street no longer want to take in terms of dealing with Bear Stearns. Is that true?
No, it's not true. There's been a lot of volatility in the market, a lot of disruption in the market, and that's causing some pressure administratively on getting some trades settled out, but we're working hard getting that done. We're in a constant dialogue with all of the major dealers and the counterparties in the street, and we are not being made aware of anybody who is not taking our credit as a counterparty.
All right. So when I'm told by a hedge fund that I know well that last night they tried to close out a mortgage, a credit protection mortgage position with Goldman Sachs that they had bought a year ago, Bear was the low bid, and I'm told that Goldman would not accept the counterparty risk of Bear Stearns. You're saying you're not aware that that would be the case?
I'm not aware that, on a specific trade from one counterparty to another, and where you're a third party, we have direct dealings with all of these institutions, and we have active markets going with each one, and our counterparty risk has not been a problem.
Why is all this out there to begin with? I mean, what do you think is causing these rumors? The stock yesterday recovered after being down as much as 11%, but as I said, it has been quite weak. The company has denied, and you're saying here there are no problems. So where does all this come from?
Well, it's very hard to say. Why do rumors start? If I had to speculate, I would say that last week was a difficult time in the mortgage business. There was talk about problems at GSEs. There was certainly some problems with some funds that were invested in very high quality instruments, but on a lot of leverage, and there were some problems there. And some people could speculate that Bear Stearns might have some problems in there, since we're a significant player in the mortgage business. None of those speculations are true, but
so Bear Stearns was trying to.
Bear Stearns had $300 billion in inventory.
So if they were trying to get rid of it, do not touch it.
That's correct. They had $300 billion in inventory. And as this memo may have gotten disseminated, the value of that inventory, a lot of which was created by Bear Stearns, originated and underwritten by Bear Stearns, in which they were the primary market maker for, began to decline. So their 30-to-1 leverage took $300 billion, which they didn't have a capital problem, marked at 300, right? And it declined by 5%, right? Which is $285 billion.
Mm-hmm, mm-hmm.
Now they have a capital problem,
right.
So as that took a turn for the worst, is when it began the dialogue with the Fed in order to backstop JP Morgan from acquiring it at $2. It ended up being, I think, $10 a share, right? And an unknown well of liabilities, right?
Don't these guys have access to the same sort of data, or does it end up being like, who's got the best analytics and because
hold on one second. If the analytics of foresight conflict with a bank's desire to make money,
then
you can raise the question of which element is going to win out.
Right.
So, the other thing is what's beginning to be developed in blockchain is the ability to securitize different components of things that have external price discovery, which can be oracleized into a smart contract. So
what does that mean when you say can be oracleized?
Oracleized. In other words, the price can be delivered to a smart contract.
Okay.
And when a price reaches a certain level, it triggers the operative elements, the execution of the contract, right? So you need an oracle for that.
Okay.
So what has been, and it's not really being talked about that much, but there are a couple of DeFi protocols where, look, at that time that Bear fell, there may have been 100 people on the planet that actually knew what a CDO actually was and how to build them, right? So, but with blockchain and crypto, you can build a contract that takes a piece of that, a piece of this, several pieces of several other things, and securitize that and go make a
Package it in.
multi-legged market on Uniswap and trade it all before your first bowl of cereal.
Right.
Right? In addition to that, the owner of that thing can literally click a single button and unwind all of the pieces and elements and revert back to the state that you were, the state of your value as it was prior to constructing these things, right? Literally, the bankruptcy case with Lehman Brothers literally just ended last week, right? That's something that we should talk about. It took 14 years to perform neurological surgery
Unbelievable.
to tracing the recourse of every CDS, CDO, and derivative instrument that led to the failure of Lehman Brothers. Whereas I just said, you can construct and deconstruct these things all within the click of a button.
So are you saying that blockchain is actually going to make it easier to create these CDOs and what's this now new acronym, this credit default swaps, to package these things up? Like, should we just
they're already making credit default swaps, but they don't call them credit default swaps.
Yeah.
Right? They call them derivatives.
Right.
Right? They're blockchain-based derivatives. Right? You can buy
and they have the same inherent risks, right?
You can buy a token that's constructed to act in the inverse of a spot price of something, a spot price of something. Right? So this gives rise to the question as to how willing banking institutions are to adopt this technology as a stack to reconstruct how they do business.
Well, if it's happening already, to your earlier point about the choice between making more money and, the risks, what are they typically going to choose, right? They're not going to want to leave money on the table if it's happening already.
Right, but in blockchain, you can click a button and unravel all of this risk long before it becomes structural or systemic.
So that's a benefit. That's a clear benefit. They're not going to stop creating these derivatives. Maybe we transition to the Lehman case. Like, what was the conclusion, and what are your thoughts on how it sort of played out?
I didn't read the case. It is thousands and thousands of pages, but obviously it started when you file for bankruptcy. You're seeking protection from creditors,
right?
Intervening, and they're staying the collection efforts. They're staying the acceleration provisions, and they're protecting the entity from its creditors.
So you mean to tell me for 14 years, these creditors have just been waiting?
The creditors committee has been deliberating on a conclusion for 14 years. Yeah.
Wow.
14 years that I paid for, that you paid for, and everybody in the United States paid for. Right?
Unbelievable. Unbelievable.
Not only did we foot the bill for the bailout, but we foot the bill for these adjudication processes in bankruptcy. 14 years, right? But you'll see, there will be a Lehman Brothers as a financial institution in the future.
It'll just morph into something
else. Into a new management team, a new entity, but that brand is storied. That's 150, 160-year-old brand.
Yeah. The same thing happened with, was it Merrill Lynch, where they kept the brand, but they sort of reconfigured.
Well, Merrill Lynch was a merger between Bank of America and Merrill Lynch during the financial crisis, right? That was a marriage that was arranged, right? So, anyway.
Well, let's talk about another topic. Last week in our podcast, you said, these cases with the SEC are a dime a dozen, and another case came up, and this is the case against Kim Kardashian. and her promotion of Ethereum Max. She's being ordered to pay $1.2 million. And they're saying she did not disclose appropriately that she was being paid $250,000 to promote Ethereum Max.
Right.
So she's dinged because she shared this Ethereum Max with her millions and millions of social media followers, but didn't put the appropriate disclosure. I guess in the context of what we do, that's what she's being dinged for. Any thoughts on that? And this is a settlement, I guess. She's decided to settle, right?
She settled, yes.
Yeah.
That's right. That means that without admitting or denying any wrongdoing,
Yeah.
she consented to the entry of findings that she failed to disclose that she was being paid to promote a security.
Mm-hmm.
So that's the snafu. In the securities industry, if a thing is a security and you're being paid to promote it, you've got to disclose that. The snafu is that her lawyers did not advise her on the implication, or they advised her and she decided to settle anyway, on the implications of making the assumption, a negative inference, that the thing that she was promoting was a security.
Right.
That helps the SEC, right? Now, I would have loved to have been a fly on that wall because I'm sure that it was brought to light, right? The SEC is trying to clean up the crypto space.
Yes.
Right? We're either going to litigate this or we want you to settle, right? To the entry findings that you promoted this security, a crypto security.
Right.
Without disclosing that you got paid to do so, right?
Yeah.
In the effort to create this whole social engineering campaign. So the SEC just spoke to all of Kim Kardashian's followers, right? And it only cost Kim, $1.25 million.
Right.
The post-settlement effects of what she can and cannot do, I'm not sure of because I didn't read the.
It said she can't promote any crypto for 3 years.
Okay, I didn't read it.
But I mean, it's nothing. Like that's nothing to her.
But that was a very loud and far-reaching announctement. A win.
Yeah.
To win for the SEC, right?
Yeah. And what is different about
the Twitterati is blasting the SEC.
Yeah.
Every day they just lay into them, but this is a really big win for the SEC. They spoke to a lot of people. And what they said was, we're coming down on crypto. There are regulations that exist already. Hire an attorney. Don't do anything wrong. We've got a framework. We're protecting you, right? Right.
And if is it too simplistic to say that if they consider Ethereum Max a security, then Ethereum's also a security?
No, that's simplistic to say.
Okay.
Ethereum Max sits on top of another blockchain.
Okay.
Right?
Well, it's a token.
It's a token.
Yeah. Yep. Got it. It does feel like there is more I don't know, just more excitement in the space. Are you doing any events coming up? I know that there's the ideas.
I am. I'm speaking at the City AM Crypto Awards.
Okay.
On Thanksgiving Day of all days.
Excellent.
I think it's the 24th of November. And then that's confirmed. So, but there are others that, we'll announce. Yeah, we'll announce.
We'll update people going forward. All right. Well, it was good catching up with you, Jason. Another good week. and some interesting insights. And for everybody who is watching on YouTube, please definitely hit the subscribe button and turn your notifications on. If you're listening to us on our podcast on audio, we thank you for being with us, and we'll see you next week.
Bye, everybody.